you're listening to Market Matters, our market series here on JP Morgan's Making Sense podcast. I'm your host, Meridy Cleary from the FICC Market Structure and Liquidity Strategy team. Today, I'm joined by Juan Badia, head of local markets in Mexico, to discuss some of the key trends in the country's rates and foreign exchange markets. Hey, Juan, thanks for joining us today.
Hi, Meridy. Great to be here. Thank you.
So to set the scene here a bit, the dust has settled from Mexico's historic presidential election in early June. And we've heard a lot of talk recently about nearshoring, which describes certain benefits that can be gained from neighboring trading partners like the U.S. From a financial markets perspective, we've also just seen the transition to T+1 settlement in Mexico in late May. And although this is just for equities markets, it's another example of market structure change in the region. Juan, you're on the ground in Mexico. I wonder if you could give us some insights into recent trading trends you've seen since the election. What are some of the notable liquidity dynamics?
Absolutely, Meridy. As you pointed out, for the last few years, MEX has been kind of a darling across EM, nearshoring one of the reasons, high carry for this currency. However, I think this year, the presidential elections in Mexico has changed the dynamics quite a bit. There was a big surprise in the election when the presidential winner gained supermajority in Congress. That was not priced at all by the market. And there was a big sell-off and uncertainty across the markets the following couple of days. That being said, the presidential winner came out with certain mitigants and comments to the market, such as the continuity of the finance minister, a clear message of fiscal discipline in the future. She announced some of her cabinet members, which are well-known names in Mexico, and things calmed down a bit. However, it's a reality that the balance of powers in Mexico have changed. The centralization of powers in the executive power has grown, and that's a bit of a concern for the market. That's why we have seen an increase of volatility and a bit of less liquidity in the last couple of months.
That's really interesting. Thank you. And we know that the Mexican peso is one of the most widely traded currencies today and has become a key tool for global investors to hedge their emerging market exposures. One key differentiator is that relative to other emerging markets, Mexico has fewer FX controls or restrictions. Juan, what stands out for you given that regulatory landscape?
Yes, it's very well known that the Mexican peso is a key currency across EM global FX. As you correctly pointed out, it's been a tool of hedging for the market, given the high liquidity, the 24-hour ability for the market to trade, open boundaries, etc. Very different from what we see maybe in other currencies across LATAM, such as Brazil, Colombia, and Chile, which only trade in certain hours and only trade in the NDF, the non-deliverable forwards market. This has helped the Mexican peso and this market to increase the level of sophistication, electronification. And, sometimes we treat Mexican peso in our systems, in our business, more as a G10 currency than an EM currency. On the back of all those reasons, again, we're seeing an increase of electronification across our business for this particular currency.
Thank you. That's a good point you make about NDF markets. We are also monitoring Brazil NDF markets and electronification there too, so that's interesting. And as I just mentioned, a key trend that we've seen is the growth in electronic trading. In Mexico, we've also seen this pick up, particularly around FX algorithms. How have you seen this evolve?
It's been very interesting. Maybe 5 years ago, we used to have maybe 2 or 3 voice traders doing MEX. Today, 95% of our activity and business is electronified. It's flowing through electronic channels such as single dealer platforms, multi-dealer platforms. An interesting data point is that 75% of the tickets that we trade are under $5 million. So obviously, electronification has increased dramatically as these kind of transactions offer more information and best execution to clients. Another very interesting data point is that the internalization of our flows for MEX has increased from 65% a couple of years ago to 95% today versus the 99% that we have in G7 currencies. So again, Mexico very fast reaching numbers similar to what we have in G7 currencies. And as you correctly pointed out, algorithm trading has increased very much in the last few years on the back of the electronification of the Mexican market.
That's really interesting around the electronification of the market. If we think about the market participants themselves in the context of the market's investor base and composition, of course, this has evolved a lot. What are some of the key client trends that you've seen across corporates, hedge funds, real money clients, for example?
How I see things, I split our activity with three different types of clients. First one is the corporate clients, which usually are more voice-driven and usually with a derivative transaction behind. Then we have the real money, which split their activity more between voice and some of our electronic single-dealer and multi-dealer platforms. These are more medium-term views that they take in the market. But then we have the hedge funds, the ones that have increased dramatically the activity in our electronic channels, given that they focus on high-frequency trading, systematic trading, and trying to arbitrage different platforms in the market.
Thank you. There's clearly a lot going on in the FX space. I'd like to shift the focus to rates markets. Mexico's Ministry of Finance and Central Bank in the early 2000s introduced measures to incentivize more trading in Mexico's onshore bond markets. Juan, if we think back since the turn of the century, what are some trends in terms of the structure of the rates market?
Absolutely. So this started in the year 2000 when the Ministry of Finance started with a figure of a primary dealer in Mexico. So this involved certain banks to be active in the local market to trade fixed income products such as M bonos and CETES to try to give more liquidity to the market. Given this increase in activity, it helped the Ministry of Finance and the central bank to start being able to issue longer tenors all the way to 30-year, which is what we have right now in our market. If we move more towards the future in 2005, 2006, we're starting to see more dealers, international dealers, coming into the market and being interested in being participant in this Mexico market. Also, it was the years when some indexes included the Mexican bonds to the index. Therefore, again, other clients started to have interest in participating in this market. If we move forward until today, we pretty much have every dealer in the street, every bank quoting these bonds, being active in these bonds, and we pretty much have every client, hedge fund, real money also active in this market.
Okay, interesting. And what has this meant for liquidity?
Yeah, so maybe 10, 15 years ago, liquidity wasn't as near what we have today. There were times when normal social quotes were about 10 basis points wide. Today we have 2 basis points wide, 1 basis point wide, sometimes even tighter than some G10 fixing products. Another thing that has triggered more participants in the market, more activity, more volume, the reason is that the derivatives now are being cleared in Mexico. So that has helped other clients that maybe didn't have the credit capacity to jump into this market and be able to participate in a daily basis.
Okay, thanks. And when we were talking earlier about FX markets and how electronified the market has become, how have you seen this evolve in Mexico's rates markets? Is it similar or is it lagging behind a little bit?
It's definitely lagging behind. Today, as we discussed, FX markets is 100% electronified. And I think the rates market is not even close to be there, right? Today, we still have many manual inputs across this business, anywhere from voice brokers, from sometimes manual booking, from manual conversation with sales and with clients. Obviously, there's a big push to develop and move into the electronification, but still the liquidity, the volume, the fragmentation, the wider spreads of this market is still not there for this to be 100% electronified.
Okay, great. Thank you. And like the FX markets in Mexico, it will be interesting to monitor Mexico's rates markets as they electronify further as well. And as we wrap up today's episode, I'd like to get your thoughts on a major market structure shift that is coming just around the corner. The TA reference rate transition in Mexico set for 2025, meaning the market is transitioning to a new overnight funding rate, which will undoubtedly impact Mexico's $5 trillion swap market. Our listeners may recall that in December 2022, the Bank of Mexico announced that the TA-28 will be replaced from January 1st, 2025 onwards. What do you think this transition will mean for rates products in Mexico, for example, interest rate swaps?
I think this transition will definitely be beneficial for the growth of the Mexico rates market. Today, we have an odd 28-day TA fixing, which you cannot compare directly to our cash products. And by doing this change and having this one-day TA, the fondeo, meaning it's kind of the Mexican one-day SOFR, clients, participants, dealers will be able to match maturities exactly to the cash and bond and zero coupon bond market. Therefore, I would expect liquidity to increase in those markets on the back of this new fixing rate.
Thank you. Well, we've covered quite a bit of ground here, and clearly there's a lot happening across FX and rates markets in Mexico, including key execution trends, shifts in market participants, and the road ahead for electronification. Thank you so much, Juan, for your insights.
Thank you very much.
And to our listeners, please stay tuned for more FICC market structure and liquidity strategy content here on JP Morgan's Making Sense podcast. To our clients, if you have any questions or would like any further information on the topics we discussed today, please reach out to your JP Morgan sales representative. I hope you have a great day.
Thanks for listening to Market Matters. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. The views expressed in this podcast may not necessarily reflect the views of JP Morgan Chase & Co. and its affiliates, together JP Morgan, and do not constitute research or recommendation advice or an offer or a solicitation to buy or sell any security or financial instrument. They are not issued by JP Morgan's research department, but are a solicitation under CFTC Rule 1.71. Reference products and services in this podcast may not be suitable for you and may not be available in all jurisdictions. JP Morgan may make markets and trade as principal in securities and other asset classes and financial products that may have been discussed. The FICC market structure publications, or to one, newsletters, mentioned in this podcast are available for JP Morgan clients. Please contact your JP Morgan sales representative should you wish to receive these. For additional disclaimers and regulatory disclosures, please visit www.jpmorgan.com/disclosures. Copyright 2023 JP Morgan Chase & Company, all rights reserved.